Hello, my CFA friends. How are you, my friends? So, we continue the journey through the CFA program overview playlist. And in this episode, we're going to be looking at the job roles. What kind of job role am I expecting to be working in after graduating? And perhaps more importantly, after spending 900 hours studying towards this thing, and after investing at least a year and a half, maybe more, year and a half, as we saw in the previous episode, was kind of the minimum path through the program, but maybe some of you will take longer because they have to resit a level or simply want to take it easier. So let's say between a year and a half and 3 years of your time is invested in the CFA program. 900 hours are invested. So ultimately, after I get that piece of paper at the end of the tunnel, what does it entitle me to? What am I likely to get in terms of salaries? Martin, show me the money. Show me the money, Martin. That's also something that we're going to see in this episode. So firstly, we're going to look at the job roles, what they involve, and basically what you're likely to be doing. And then we will look at the salaries. So let's get started. All right, well, the most popular job role is that of the portfolio manager. Okay. And I don't think that is surprising because really the CFA program is geared towards portfolio management. Look at what happens at level 3. Essentially, portfolio management becomes kind of almost half of your exam. Right now at level 1, it is also pretty heavy. It's 12%, and then it increases to 15%. Eventually, it's going to be half of your exam. So not surprisingly, the CFA program is geared towards portfolio managers. Now, what does a portfolio manager actually do? Well, he selects and manages stocks and bonds, or maybe funds, aiming to grow the portfolio while balancing risk and return. So managing assets, essentially maximizing return per unit of risk. You know the drill. We've already been talking about portfolio management on this channel. We've talked about CAPM, CML, SML, all that good stuff will come back and smile at you again and again throughout the program. And it's going to get more and more exciting as you progress. So definitely my advice is keep studying your portfolio management from day one, from level 1. Although at the moment it feels like it's a niche area, it feels like there's a lot more to worry about elsewhere in the syllabus, aka FSA. But my advice is start getting better at portfolio management from day 1. Now, perhaps one slight downside to the PM job, it is not an entry-level position, so you are unlikely to be sort of rocking up and saying, I want to be a portfolio management and getting the job straight away. Typically, you're gonna need some years of experience as an associate, as a research analyst before you're considered seriously for a portfolio management position. Because, of course, you guessed it, a portfolio manager manages a lot of money. And so we need to know that you've got the right amount of experience. Now, the next job role is that of the research analyst. And the good news here is that is probably the most typical entry-level position for most professionals wishing to enter the finance arena. So what does an analyst do? An analyst analyzes. What a shocker! An analyst is able to analyze financial and economic data in order to make informed decisions, again, about buying or maybe selling stocks and bonds. Now, I'm obviously saying stocks and bonds being our traditional assets, but in this day and age, we, of course, can extend this to many other things. Of course, you've got commodities in real estate and hedge funds and private equities, but of course, we now have also digital assets such as crypto. So when I say stocks and bonds, of course, I'm not limiting your analysis to only stocks and bonds, but these are the most typical roles for the research analyst. The research analyst will also have to choose whether he wants to be a buy-side person or a sell-side person. And if you don't know what these terms mean, I've prepared the next couple of slides to illustrate that. All right, let's say you want to be a buy-side research analyst. So who are these buy-side entities? Well, these are the entities that actually invest money. So here are some examples. You could have mutual funds. Now, of course, you all know about BlackRock. Unless you've been living under a rock, you know BlackRock, you know Fidelity. These are very, very large, if not the largest asset managers in the world. Then you've got hedge funds, of course, which use funky strategies, short selling, derivatives, illiquid assets, basically funky strategies aiming at absolute return. So here an example would be Bridgewater Associate, which is managed by famous Ray Dalio. Then you've got private equity. Well, as the name suggests it, private equity is going to be managing or making investments in companies that are not public but are private. So the three main pillars here are really venture capital. This is where you work for someone who's going to be investing in early companies with amazing growth potential. Then growth stage is when the companies are now expanding, and then LBO typically invests in mature companies, takes a lot of leverage, takes a lot of debt in order to take the once public companies private. So this is a private equity. And again, here I've got an example, Blackstone, not to be confused with BlackRock. So BlackRock is a mutual fund, well, it's an asset manager, whereas Blackstone is a private equity firm. Okay, well, then I've got pension funds and insurance companies. Remember, this list is essentially asset owners, firms that manage money. That's what we're going through here. So obviously, pension funds are going to invest on behalf of their future retirees. Insurance companies are going to be collecting your premium on your car insurance, on your house insurance, on your health insurance, and investing those. And of course, if you ever do have to claim, they will sell that investment in order to make a payout. I live in the UK, so I'm going to give you a UK example. Aviva is a very big company here in the UK, which offers both pensions as well as insurance. Then you've got SWFs, and that stands for Sovereign Wealth Funds. And here I've given you the example of the Abu Dhabi Investment Authority. Now, often the sovereign wealth funds, most of the time, are funded through oil revenues. So if you were lucky enough to be a country that sits on top of oil reserves, then you can extract those oil reserves and sell them to the world. You collect dollars for that, and then what do you do with those dollars? Well, you buy stocks, you buy bonds, you buy real estate, you buy gold, and you will have the sovereign wealth fund, which is managing all these wonderful assets on your behalf, on the behalf of the country. So, you can be a buy-side analyst working for a sovereign wealth fund, for example, or you could work for a foundation. So remember Bill and Melinda Gates Foundation. That will be an example of a foundation. So I associate foundations with charitable activities. So they may have certain mission, for example, eradicate poverty or disease around the world. And then you've got endowments. I associate endowments with universities. For example, famous one is the Harvard Endowment, where if you're an alumni, you will basically donate some money to Harvard, and they will have a lot of money then to invest and to use the income from the endowment to fund their operations or expand the campus or something along those lines. And again, you could be an analyst working for these entities. You could also work for family offices. These guys are catering to the needs of ultra high net worth individuals. That's what that acronym stands for. But okay, we've seen what the buy side does. Now let's turn our attention to the sell side and let's see who the sell side analysts might work for. So sell side are generally involved in things like S&T and M&A, so sales and trading, mergers, acquisitions, raising capital, or providing advice. So generally speaking, to cut a long story short, I would say sell side is investment banking, really. So who are the big investment banks? And this is, of course, not an exhaustive list, just an example. We've got Goldman Sachs, we got JP Morgan, we got Morgan Stanley, we got BAML, Bank of America, Merrill Lynch. Remember that those guys merged during after the GFC when companies were in trouble, banks were in trouble. Got Citigroup, we got Deutsche Bank, and of course, we've got the Union Bank of Switzerland, better known as UBS. So if you work for any of these guys in an analyst role, then you will be referred to as a sell-side analyst, because these guys are not really the asset owners. They're not managing the money. They are typically either selling those securities to investors or providing some sort of advisory service or some sort of brokerage service. And again, talking about brokerage as an example, Charles Schwab would be an example of a brokerage service. So remember, when you go brokerage, you are really the intermediary between the buyer and the seller. So if I go on some sort of portal like E-Trade, I don't know, depends where you live, you will be able to give better examples of what a brokerage account would be, but most of them nowadays are online brokers. So you just log into your online broker and you place orders to buy or sell securities. So they basically just execute on your behalf and collect a commission for doing so. So they don't own the assets. But you could still work as an analyst for those brokerages or the investment banks, because you're going to be able to issue either buy or sell or hold reports. Okay, and then you got advisory. Well, these guys, as the name suggests it, are focusing on providing advice. So this advice may be in relation to raising capital. So I'm advising a company on when and how and what tools to use to raise capital. Or maybe I'm advising a company on its M&A activities, on its opportunities to buy and sell other companies. And the example here I've got is Lazard. All right, then the third job role is that of the investment consultant. So consultants, that's a sweet job if you ask me, because all you're going to be doing is providing advice, right? A bit like the advisory service of the previous slide. So here you're the individual providing the advice, and we will call you an investment consultant. So a bit like a financial planner, really, but a financial planner is typically a certified role in America, so you probably need to take additional exams for that. But here you are a consultant, and you will be advising your clients on which assets to own, asset classes or funds, which ETFs to own, or which countries to invest in. So typically, if you're going to be doing this, you can't be a career changer. You can't be a major in art or history. You probably are going to have quite a bit of knowledge of finance theory and financial markets. So typically, you're going to be coming from maybe a background where your undergraduate or bachelor's degree was in economics or accounting. And then we've got the risk manager. Now, guys, I also teach the FRM, which is the financial risk manager. So I can speak a lot about risk management here, but I'm going to try to keep the video very, very short and to the point. So risk managers measure. So how do we measure risk? Typically, we use something called value at risk or expected shortfall. These concepts are mentioned in passing in the CFA program, but if you really want to know a lot about them, you're going to have to go and do the FRM. and ultimately managing different types of financial risks. So what are the kind of major types of financial risk? You've got market risk, so exposure to the markets. So S&P going up and down every day, the roller coaster, or bond prices going up and down, or commodity prices or FX moving. That's all under the umbrella of market risk. Credit risk is when you lend money. So it's basically the exposure to your counterparty. So we're going to be talking about things like probability of default, loss given default, expected losses, unexpected losses. These are all concepts from credit risk. Operational risk is a catch-all category that basically includes anything that's not market or credit related. So it could be an earthquake, it could be basically a natural disaster, it could be a blackout, it could be malware infecting your system, it could be a settlement mistake where you press a button twice, send money twice, or some sort of fat finger risk. It could be a rogue trader bringing your bank down. So remember, we had Jerome Kerviel at Societe Generale. I think he lost something like $7 billion. So obviously, operational risk is really, really painful when it does occur. It could be considered a low frequency but high severity event, and it could potentially bring a bank down. You may have heard of Nick Leeson at Barings Bank in the 90s. He was placing unauthorized trades from his Singapore office, and that resulted in Barings having to file for bankruptcy ultimately. So that's going to come under operational risk. So you're going to have settlement officers, you're going to have back office people who are supposed to make sure that these traders are not overstepping their authority. And of course, post-2010, post the GFC, we have all realized there's also liquidity risk. So liquidity risk typically could come in two shapes. You could be trying to sell an asset and be unable to sell it quickly at fair value, or also it could come in the shape of rollover risk, where you are funding an investment in long-term assets by financing yourself or using short-term liabilities such as commercial paper or overnight repos. And of course, if a crisis hits you, then that borrowing disappears, that source of funding for you disappears, and you may slip into trouble. We had a company here, a bank in the UK, good example, called Northern Rock, which ultimately had to be bailed out by the Bank of England, by the lender of last resort. So again, if you're a risk manager, you're gonna be looking at either an aspect of this, or maybe ultimately all aspects of risk. If you do progress to become a CRO, a Chief Risk Officer, then you will be overseeing the heads of market, credit, and operational risk. So to cut a long story short here, if you're finding risk management exciting, then you may want to consider CFA plus FRM. I'm not going to say I'll just go for one or the other. I personally hold the CFA charter, the Kaya charter, and the FRM charter, and I won't look back. It was a great learning experience, and I would recommend, if you also love studying and if you love passing exams, go for as many of these charters as possible. And if you certainly are planning to work in risk, then FRM is an obvious choice, but also you're going to be wanting to combine this with the CFA. Maybe in a future video, I will cover the key similarities and differences between the CFA and FRM. Now, it's all well and good that you want to work as a sell-side analyst for Goldman Sachs, but ultimately, show me the money, Martin. Show me the money. And I want to start here at the bottom. By the way, these are not numbers that I have calculated in any way. I just went on the CFA Institute website, so that is the source of this information. And it is based, I believe, on a survey that was carried out a few years ago, maybe even pre-COVID. So given that we've experienced at least 50% inflation since then, I'm very much hoping that these numbers have also increased, although I know that one thing is inflation out there in the street. Another thing is by how much your employer will increase your salaries. I know that very well. But anyway, we'll look at the numbers. These are typical global total compensation numbers. We're going to start with the lowest number, which is that of the risk manager. So a risk manager is looking at earning about $130,000. Notice that is the base salary plus any additional compensation, such as bonuses, and then consultant come just above that at 131,000. Remember, the consultants were those guys that were basically providing advice. Then comes the analyst, and this again, I would say probably either median or average numbers. So maybe you can get more, maybe you can get less. Also, it's obviously going to depend on the country you live in. Okay, so I know a lot of people watching me from India. Now, these numbers may not be relevant to India, but I'm telling you, these are the global numbers that the institute is providing. So if you're a research analyst, you're going to be looking at 140,000. Remember, these numbers hopefully are being updated for inflation. I very much hope so anyway. And then the big one is going to be, drum roll, the salary of a portfolio manager, which is coming at 177,000. But remember, you can't just rock up and become a portfolio manager. You kind of need to show some experience. You kind of need to show that you've been in the industry for some time. So I hope you found this short session useful, my friends. If you are considering the CFA program, you may want to book me for a Zoom consultation. Just email stoyanov.financial@gmail.com or check out my website at stoyanov.co.uk. Thank you very much for watching and have a great day.